Hello, this is Kirk Lynch, and today's lecture will continue with the accounts receivable, and this time we're going to talk about the allowance method and how do we determine the amount of that adjusting entry at the end of the accounting period.
The previous lecture on the methods to write off uncollectible accounts introduced the allowance method for writing off accounts that are deemed uncollectible. Step 1 of that process was to calculate the amount of the adjusting entry to be made at the end of the financial period so expenses could be matched with the revenues in the same accounting period. That lecture discussed the process. This lecture will discuss how to calculate the amount to be adjusted. The two methods that we will introduce are both acceptable for providing an estimate to the allowance account. You may recall that this estimate is an educated guess as to how much bad debt will be written off in the upcoming accounting period. The two methods we will discuss are the percentage of sales method and the analysis of accounts receivable method. The percentage of sales method is by far the easier of the two. However, the analysis of accounts receivable method is more accurate. We will discuss each separately, starting with the percentage of sales method. The percentage of sales method simply takes the total sales made on credit during the accounting period and assumes that a certain percentage of those sales will not be collected. The percentage number can be derived based on history of collections for the company. If the company has no history, a number from the industry or a similar company can be used until a history can be established. For your purposes, this percentage will be provided. As an example, if BH Sports has credit sales of $250,000 and based on past history it is shown that 1.25% of those sales will be uncollectible, then our adjusting entry to record bad debt expense and populate our allowance account can be determined by the following equation, seen at the bottom of the screen. 250,000 times 0.0125, which is 1.25%, equals $3,125. Using this method, we are estimating that $3,125 of our accounts receivable will not be collected in the next financial period. The adjusting entry for the item is then journalized. It's important to note that using this method to record bad debt expense, we disregard any balance that already exists in the allowance for doubtful accounts account. We simply record the following adjusting entry: debit bad debt expense for $3,125 and credit allowance for doubtful accounts for $3,125. To further clarify, if at the end of year 1 our allowance for doubtful accounts had a credit balance of $500, in other words, we didn't write off as much as we thought we were going to have to this past year, we would then do our adjusting entry of $3,125, and the new balance in our allowance for doubtful accounts would be $3,625 after our adjusting entry. In contrast, assume that after year 1, our allowance for doubtful accounts has a debit balance of $300. In other words, we wrote off more last year than we thought we were going to have to. And so after our adjusting entry of $3,125, the new balance in our allowance for doubtful accounts would be $2,825, as shown in this T account. This disregard for previous balance in the allowance for doubtful accounts account is unique to the percentage of sales method. We will see shortly that the analysis of accounts receivable method takes existing balances in the allowance for doubtful accounts into consideration when recording the adjusting entry. The analysis of accounts receivable method of estimating uncollectible accounts for the next financial period involves looking at all of our accounts receivable and doing a detailed analysis of the state of those receivables by determining exactly how old our account receivables are. The older the money, the less likely it will be collected. Accounts receivable is broken up into buckets of money, illustrated in this table shown on this slide. We see our total accounts receivable is $180,500, and of that $180,500, $65,800 is current. In other words, not past due. These are sales that have been made in the past 30 days, and assuming our credit terms are net 30. Accounts that are overdue are broken into those 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, 91 to 120 days past due, and those over 120 days past due. And we have balances in each of those categories shown here. In our 1 to 30 day past due, we have $18,900. In our 31 to 60 days past due, we have $25,500. In our 61 to 90 days past due, we've got $64,400. In our 91 to 120 days past due, we've got $3,400. And in our category for over 120 days past due, we have $2,500 in that category. All of these categories added up provide us with our total outstanding accounts receivable, which is $180,500. Here we see a typical schedule of accounts receivable. Notice that the individual customer records, as well as the totals, each of the categories have been determined, and we can extrapolate a total accounts receivable that will likely not be collected. From past history or industry averages, we can make assumptions about the amount in each category as a percentage that will not get collected. For your purposes, these percentages will be given to you. In this example, we can see that the money that is current, we expect to collect 98% of that money, which means 2% will not get collected on average. Again, this number is most likely based on past history, and as we move through the categories, we see that the older the money becomes, the higher percentage of that money will not get collected. In our example, we see here that 1 to 30 days past due, 6% we estimate will not get collected. 31 to 60 days, 12% will not get collected. 61 to 90 days, 25% will not get collected. 91 to 120 days, 32% will not get collected. And money older than 120 days, 65% of that money is estimated will not get collected. Again, these percentages will be given to you in problems. However, most businesses will have history of uncollectible accounts, and each category they'll know approximately how much will not get collected. This provides us with a very accurate estimate as to how much we're not going to be able to collect of our money that's outstanding. By taking the total money in each category and multiplying it by the percentage that's projected will not be collected in that particular category, we can come up with an uncollectible amount in each category. And if we add these subtotals together, we can have a fairly accurate representation of our total uncollectible accounts for the coming financial period. In this case, our total uncollectible accounts estimate is $24,323, and that's made up of $1,316 in our not past due, plus $1,134 in our 1 to 30 day past due, $3,060 in our 31 to 60 day past due, $16,100 in our 61 to 90 days past due, plus $1,088 in our 91 to 120 days past due, and $1,625 in our category for over 120 days past due. Adding them all up, we see our total uncollectible estimate, $24,323. This total represents the desired balance in the allowance for doubtful accounts based on our current outstanding collectibles. Notice I said desired balance because our goal in the adjusting process is to end up with this balance in our allowance for doubtful accounts after we have completed the adjusting entries. This differs from the percentage of sales method. In the percentage of sales method, our adjusting entry was made regardless of any existing balance in the allowance for doubtful accounts account. Using the analysis of accounts receivable method, we want to end up with a specified balance in our allowance for doubtful accounts account, so we need to consider the current balance prior to making our adjusting entry. To demonstrate, our analysis had indicated that a total uncollectible account of $24,323 from a couple of slides previous to this, we came up with that number for our coming financial period. In other words, we've guessed that in our the upcoming financial period, $24,323 is not going to be collectible based on our analysis that we've done. And so that's the ending balance we would like to have in our allowance for doubtful accounts. So if we assume that our allowance for doubtful accounts before our adjusting entry has a debit balance of $450. In other words, we wrote off $450 more this past period than we anticipated we would have to. Then we need the following adjusting entry in order to get our balance to be the desired amount of $24,323. And that amount of our adjusting entry would be $24,773. And we see in our T account the credit to allowance for doubtful accounts for the $24,773, giving us the desired balance of $24,323. And at the very bottom of the slide, we see the journal entry that we would record after we've estimated our allowance for doubtful accounts number, and we see the entry made there to get to the point we want to be at. Now, on the other hand, if our allowance for doubtful accounts had a credit balance of $700, which means we wrote off $700 less this past accounting period than we anticipated we would have to, we would need an adjusting entry to make our ending balance in the allowance for doubtful accounts again to our desired balance of $24,323, and in order to get there, our adjusting entry amount would be $23,623. And here we see on our screen a T account with the $23,623 credit, giving us the desired ending balance of $24,323, and then we see a sample journal entry at the bottom showing a debit to bad debt expense for the adjusting amount, $23,623, and a credit to allowance for doubtful accounts for $23,623. Now, in summary, the percentage of sales method ignores any existing balance in the allowance for doubtful accounts when making the adjusting entry. The adjustment is calculated and the money is added to the allowance for doubtful accounts, and the new balance is whatever it ends up being. In contrast, the analysis of accounts receivable method is more precise, and a specific allowance for doubtful accounts balance is desired. Therefore, the existing balance in the account is taken into consideration prior to making the adjusting entry, such that the desired ending balance will be achieved. This concludes our discussion on estimating uncollectible accounts. I hope this explanation has been helpful. Make sure you review the sample problem on estimating uncollectible accounts, and I look forward to meeting with you again in the future.